This is the final lesson of T4 Advanced. Today we organize, in plain academic language, the ride the trend strategies people actually use in live markets. What you'll learn: the difference between time series and cross-sectional momentum, what trend following, CTA, is, the premium called carry, and the 4 traps where backtests lie. There's an old saying, the trend is your friend. It means following the trend can make money. Today we check honestly with data framing when that holds and when it really doesn't. By the end, you should be able to judge for yourself. Should I follow the trend or fade it? Looking at this S&P 500 weekly chart on screen, via SPY, let's talk momentum, how strongly price keeps moving in one direction. There are 2 kinds. First, cross-sectional momentum, relative momentum when you line up many names. Who is stronger? You rank them, like opening a class of 30 report cards and asking, how far ahead is the number 3 student? Absolute score doesn't matter, only rank changes. Second, time series momentum, absolute momentum, you only ask whether this asset itself has been winning or losing over the recent window. No peer comparison, like did my own grades rise versus 3 months ago? In practice, we use time series momentum far more often. It works on a single name, and you can apply the same idea across futures, FX, and bonds at once. Both trend following and carry that we cover today start from this time series idea. Like the Bitcoin daily chart on screen, trend following, CTA, Commodity Trading Advisor, is a time series momentum strategy. Buy along rising trends, reduce along falling ones. Key trait: not just one asset like Bitcoin. You run stocks, futures, rates, FX, and commodities together. Spot an uptrend in equity indexes, an uptrend in crude oil, and a soft dollar at once, and you can take exposure to all 3. Think of it as a multi-trend following portfolio. Why mix markets? Diversification. If you only buy stocks and equities fall, you're 100% in that loss. If you're also riding a crude uptrend, that sleeve can partly offset. That's the theory. Reality has risks. In a financial crisis, many markets fall together and diversification breaks down. In long sideways ranges, no trend, small losses pile up. Example shape: 3 months of chop for -2%, then 1 strong trend month for +5%. Patience and position sizing are everything. Using a dividend-paying basket like the S&P 500 weekly chart on screen, carry is the interest, dividends, or premium that arrives automatically while you hold the asset, independent of price moves.
3. 이그젠펠즈. 더 S&P 500온 스크린 해즈 히스토리클리 페이드 러플리 AE 3% 디버덴드 일드 AE이요.
By a higher-yielding currency, say the Australian dollar, and the rate differential can drip in day by day, e.g. around 3% annualized. Corporate bonds pay coupons on a schedule. Academically, this holding premium shows up in data across FX, bonds, commodities, and more. Plenty of papers. In quiet times, the payoff is modest but steady. That was the appeal. Reality check. Historically, carry strategies often look like small gains most of the time, one big loss in a crisis. In the 2008 financial crisis, high-yielding currencies devalued more than 20% in a month. Calm seas, then a storm. Risk management really matters.
패스트 데이터 온 A 클린 S&P 500 위클리 차트 록스 타이디.
Don't trust a back-tested return at face value, for traps are hiding. Survivorship bias. Delisted names vanish from the dataset. What's left are the survivors. Backtest only the S&P 500 names that still exist years later, and the average return looks better than live reality. The failed companies never show up. Look ahead leakage. You quietly use information you wouldn't have known at that past date. Example, before the September 2008 Lehman shock, if your code knew tomorrow's headlines and traded perfectly, timing looks flawless. Impossible in real life, but a bug can sneak it in. Overfitting. Tune a strategy until it fits only that past sample and it looks perfect historically, then fails going forward. Like a finger trained to fit exactly one hole. Ignoring costs. Live trading has commissions, slippage, and taxes. Add them and 20 to 50% too of backtest profit can evaporate. Wrapping up on the Bitcoin daily chart. A good past return does not guarantee the future. Same for factors and trend following. Case, the academic value factor. Cheap stocks earning over the long run worked well from the 1990s into the early 2010s. From about 2010 through the 2020s, results weakened.
Why?
Once every fund knew the playbook, competition got fierce. So, this secret of success isn't a secret. Hold 3 habits. Revalidate honestly at today's date, subtract fees, taxes, and slippage so expectations stay realistic, cut losses with discipline the moment your rules say stop. Expected value, reward to risk, and validation grades. We learned our tools for living those 3 habits. Basics, not magic tricks, are what win. On the Bitcoin daily chart again, you finished the T4 advanced module. For things to remember, momentum splits into relative, rank comparison, and absolute, self-comparison, and trend following, CTA, is a portfolio that hunts trends across many markets at once. Carry is dividends, interest, and premium just for holding, and in a crisis, it can get cut in half in one shot. Backtests are always under pressure from 4 traps: survivorship bias, look-ahead leakage, overfitting, and trading costs. This advanced block is the live market expansion of main track T4 financial engineering. Watch the main track's final lesson on capital flows and seasonality, and these pieces snap into one full investing blueprint. Important disclaimer, this lesson is educational only. It is not a recommendation to buy any specific security, and it does not guarantee future returns. Every investment decision and every loss is entirely your responsibility. Thanks for staying to the end. Subscribe, like, and leave a comment with your thoughts. It really helps us make better lessons.